Hello everyone and welcome you all to our presentation on advanced financial accounting. We are group 18 from the 22.2 batch of BM honors in accountancy and finance at NSBM Green University, and we truly excited to share our insights with you today. Thank you for taking the time to join us. In this presentation, we will be analyzing and comparing the financial performance of two Sri Lanka's leading companies, John Keells Holdings PLC and Hemas Holdings PLC. Our main objective is understand how these companies perform in terms of profitability, financial health, and efficiency using real-world financial data and advanced accounting techniques. This analysis not only helps us as a student to apply theoretical knowledge but also reflects how such financial evolution guide business strategies and stakeholder decisions in the real world. Okay, now let me briefly explain you through what you can expect in this presentation. First one, introduction. We will begin exploring the core financial statements, the income statement, balance sheet, and cash flow statement of both companies. The second one, financial overview. We will take a deeper look into how each company positions financially. The third one, ratio analysis. We will assess their profitability, liquidity, gearing, and efficiency through key financial ratios. The fourth one, use of data. We will explain where our data comes from and how we used it. The fifth one, comparative analysis. We will compare the key metrics between the two companies. The sixth one, interpretations of results. We will highlight the numbers really mean and what insight we can draw from them. Finally, we will wrap things up, a conclusion, and share our recommendation based on our findings. You might ask, why is this important? Financial analysis is at heart of smart decision making in a business. Whether you are investor, manager, or a future accountant like us, understanding a company financial health helps to make informed choices. It shows not just what a business is doing, but how well doing it. So once again, thank you for joining with us. We hope you find this presentation informative and engaging. Let's begin the taking a look the financial statement of John Keells and Hemas. I'll now hand it over to my teammate who will walk you through the financial overview.
According to my part, I'll be presenting a brief financial overview and the use of data in two of Sri Lanka's leading companies, John Keells Holdings and Hemas Holdings. Let's start with John Keells Holdings, commonly known as one of the largest listed companies on the Colombo Stock Exchange. It operates various sectors including transportation, leisure, property, consumer goods, and retail and financial services. The company regularly publishes detailed financial statements, and its use of data analytics to play a key role in its business operations, especially in retail and logistics, where real-time data helps optimize supply chains and improve customer experience. Moving on to Hemas Holdings PLC is another diversified group with a strong presence in healthcare, personal care, mobility and leisure sectors. The use of data at Hemas is increasingly becoming a strategic tool, from forecasting demand in its pharmaceutical distribution arm to consumer insights in its FMCG brands. Hemas leverages data analytics to drive starter decision making, optimize operations, and enhance customer satisfaction. Both companies have demonstrated strong financial foundations and growing reliance on data-driven strategies to stay competitive in today's dynamic business environment.
start net profit ratio. This ratio tells us how much of each dollars earned by the business translate into actual profit after tax. It is calculated net profit after tax divided by sales revenue multiplied by 100. A higher percentage means the company is more profitable. Next, we have gross profit margin, which measure how efficiently a company produces its goods. It's calculated gross profit divided by sales, again multiplied by 100. It shows the profit before overhead and other expenses. The operating profit margin, giving insight into the core operational efficiency of the business. It considers operating profit over sales revenue. Now we have several specific expenses ratio like the expenses ratio, distribution expenses ratio, financial cost ratio, and administrative expenses ratio. This ratio break down individual cost areas as percentage of sales, helping business identify where they might reduce cost. Next discuss return on capital employed shows how well a company uses its capital to generate profit. It's calculated as profit before interest and tax divided by capital employed. Lastly, the return on equity reveals how efficiently a business uses shareholders' equity to produce profit. It is simply profit after tax divided by total equity. All these ratios combined help investor, analyst, and business owner make more informed decision about profitability and operational health.
Today I will present liquidity ratio. Liquidity ratio measures a company's ability to pay short-term debt and meet operating expenses. There are two types of liquidity ratio. First one is quick ratio, second one is current ratio. Current ratio measures a company's ability to pay off its short-term liabilities with its short-term assets, obligating whether it has enough resources to cover its debt over the next 12 months. Quick ratio measures a company's ability to meet its short-term obligations using its most liquid assets. These two types of ratios, which belong to the liquidity ratios, have been calculated for the two companies, John Keells and Hemas.
Is gearing ratio. Gearing ratio measures a firm's ability to make long-term obligations with higher debt levels, indicating greater financial risk. There are three key long-term solvency ratios. First one, debt to equity ratio. Second one, debt to total assets. Third one, interest coverage ratio. So these three ratios have been calculated for the two companies, John Keells and Hemas.
Thank you. I'll be presenting on efficiency ratios. Let's start with the inventory turnover, which is calculated as the cost of sales divided by average inventory. This ratio tells us how quickly inventory is sold and replaced. Next is the stock residence period, which shows how long inventory stays in stock. It's calculated by dividing 365 by the stock turnover. Debtors turnover is credit sales divided by average trade receivables. It reflects how efficiently a company collects payment from its customers. To understand how long it takes to collect debts, we use the debt collection period, which is 365 days by the debtors turnover. Thank you.
On the supplier side, creditors turnover is calculated as purchases divided by average creditors, showing how quickly a company pays its suppliers. The creditor's payment period, which is 365 divided by creditor's turnover, tells us the average time the company takes to pay its creditors. Finally, the assessed turnover ratio minus sales divided by average assets minus measures how to effectively the company uses its assets to generate revenue.
Comparative analysis. In this session, we analyze and compare the financial performance of John Keells Holding PLC and Hemas Holding PLC using key financial ratios from their 2023-24 annual report. The focus in on profitability, liquidity, efficiency, and gearing ratio. We observed difference in profit margins, where one company showed strong control over expenses and better return on equity. In terms of liquidity, both firms maintain responsible current and quick ratio. Thought one displayed a more conservative short-term financial position. Efficiency ratios such as inventory turnover and debtor collection period highlight how efficiently each company manages its working capital. Gearing ratios provide insight into their financial risk, how much they really on debt versus equity. This comparison on not only reveals the relative financial strength and weakness of each company, but also help stakeholders make informed decisions based on stability, profitability, and risk exposures. Thank you.
My part is the interpretation of the results. We mainly consider about key insight from the analysis and implication of the stakeholder. Hemas is the smaller company within the less market, and their reach with John Keells Holding is the largest company within the many business and strong finance and big influence in Sri Lanka. Thank you.
Thank you. My part is recommendation and conclusion. I talk about firstly recommendation. First one is improving cost efficient. Second one is optimizing working capital. Third one is enhance investors communication. Fourth one is benchmark performance. Fifth one is strategic investment. And I will talk about conclusion. The conclusion is the financial analysis of the John Keells Holding PLC and Hemas Holding PLC disclosing the key differences in profitability and liquidity and operational efficiencies. Both companies illustrating financial stability. John Keells showing the stronger profitability ratio, while the Hemas maintaining a more balanced liquidity position. These assign for valuable direction for stakeholders and evaluate investment potential and strategic lineup. This is our end of our presentation. Thank you all.